Hi, and welcome back to the Mortgage Musketeer. My name is Sean Neely, and today we're going to be talking about FHA loans. What are they? What are the requirements? How do you qualify for them? What are a lot of the frequently asked questions? Alright, so what is an FHA loan? An FHA loan is a government-backed loan, and what that means to you is that you can qualify for mortgage money that ordinarily you wouldn't be able to qualify for with a conventional mortgage. So that allows you to be a borrower that maybe has a little bit more risk in accordance with the lending industry. And that's usually in regards to your debt to income ratio and your credit score. So with an FHA loan, your debt to income ratio can go up to as much as 56%. Should it? That's a different story, but can you qualify with it? Yes, there are circumstances where people have more money that they're making than we can actually use for debt to income calculations. So it may look a little higher, but you know that you're going to be okay because you have enough money coming in. So it allows you to go up to a 56% and kind of mitigate some of those lending factors on the debt to income ratio side. On the credit score side, you can go down to a 580 with an automatic underwriting approval, and your loan officer should be running that. You cannot just assume that if you've got a 580 to a 620 that you're going to be approved. You got to run it. 620 and above, you're usually going to be in good shape if you have some of your own assets. 640 and above seems to eliminate a lot of the layered risk that pops up when it's looking at your credit profile in the automatic underwriting system. All that is run by your loan officer, and they'll walk you through it. What you need to know, though, is you can actually qualify for a loan with a lower credit score. Now, lenders can put an overlay on those guidelines. For instance, during the whole coronavirus thing right now, they have recently raised it up to a 640 and above only, even if you have an automatic underwriting system approval. So that can create a little bit of challenge. So you've got to talk to your loan officer. Different lenders have different programs, and they're willing to accept different levels of risk. That will change. Once this whole coronavirus thing goes away, we'll be all right. It'll drop back down. Okay, now, the other side to that is it is going to allow you to get into homes that you ordinarily wouldn't qualify for because of these factors. But there are some limitations. First of all, you have a county FHA loan limit, and that depends on the county, and it's really easy to figure out. You can Google it. I'm going to attach a link down in the comments below that you can actually click and go figure out what is the FHA loan limit for your area. For instance, where I live in Louisville, the area in Kentucky, the FHA the FHA loan limit for Jefferson County is $333,500 as of today. Now that changes every single year, and it tends to go up. So as the economy grows and as the housing market expands, they change those limits every single year. So you got to look them up. Now, if you look at outside in like Pike County in eastern Kentucky, their loan limit is $331,760. If you go up into Minnesota, into like Meeker County, then it's the same, $331,760. Now, if I was to go into Maryland, it would be a lot higher. So it just depends on what state that you live in and what county you live in. Look it up. It's too easy. It eliminates any question because the knowledge is right there. All right. The other thing to remember is that because this loan carries with it a little bit more perceived risk because you have either a lower credit score or a higher debt to income ratio, these loans are going to come with mortgage insurance premiums, and there's two pieces to that. The first one is the upfront mortgage insurance premium. So because the federal government is backing up this loan, it is federally insured. But who pays for that insurance? Well, you do as the buyer. You're assuming your own risk in a way. You're basically saying, hey, I'm going to pay my insurance to let you know I'm going to be good for this money, and then the federal government is going to reimburse or take care of the investors who lend you the money. Now, the upfront mortgage insurance premium right now is 1.75%. So they'll take that 1.75% and that will be upfront. Now, most of the time that is rolled into your loan. So you're not paying that out of pocket. But what that does do is give you reduced mortgage insurance itself, which currently is 0.85% if you put anything less than 5% down. If you put 5% or more, it'll be 80%. Okay? Oh, 0.80. All right, so 0.80 and 0.85 respectively. Now, what that means is every month you're going to be paying that mortgage insurance as part of your mortgage payment. So when you're looking at your total mortgage payment, you got to remember there's principal and interest, there's homeowners insurance, there's property taxes, and then the mortgage insurance. So obviously the more expensive house that you have, if you're buying a $300,000 house, the mortgage insurance premium is going to be a couple $100. If you're buying a $100,000 house, it's going to be a lot less. All right, so it's just how that math works out. But what that does is allows you to also have lower interest rates. Because the government is backing this up and because you're paying the mortgage insurance premium most of the time, the interest rates are going to be lower. The only time that doesn't happen is when the market kind of goes crazy, and that happens from time to time, and then there's not a lot of appetite for these types of loans, in which case the interest rate might go a little bit higher. We're seeing that happen right now in the coronavirus. But again, once the markets settle, it'll drop back down. I've seen that happen from time to time. I've seen it happen around Christmas and New Year's one year. For whatever reason, there was no appetite in the market for that, and it has to do with everything else going in mortgage-backed securities and treasuries and a lot of other things. But it can fluctuate a little bit, so you can't always assume, but your lender will let you know what's going on. In general, though, FHA loans are going to have a really low interest rate, which is fantastic because it allows you to get into the homes and helps you with the debt-to-income ratio and helps to offset that mortgage insurance premium. Now, that mortgage insurance premium, if you put anything less than 10% down on the loan, that mortgage insurance premium is going to be on the loan for the life of the loan. So the only way to get rid of that is to refinance out of it later. And a lot of people, once they reach an 80% loan to value, they will refinance out of that FHA into a conventional mortgage that will eliminate the mortgage insurance premium. If you put 10% or more down, then that mortgage insurance premium is going to drop off after 11 years. Okay, so another thing to know is that if you have student loans, and a lot of people that are first buying a home or trying to get going might have student loan debt. So even if they are deferred, FHA requires us to take 1% of the loan amount. Okay, so if you have $100,000 in student loans, that's $1,000 added to your debt to income ratio, and that can be pretty painful in regards to your debt to income ratio. The other thing people don't know is that an FHA appraisal has an inspection component to it. So when you order the appraisal, they're going to go out there and they're going to check the home, and they're really looking for the health and safety standards. And these health and safety standards there's a checklist that the appraiser is going to go off of. It's not to be confused with a home inspection that you pay for to have a home inspector come look at the home. It is different. Okay, so the one does not replace the other. But when they go into the home, they're going to go off of this checklist and make sure that certain things aren't in the home. For instance, if there's no handrails on the steps, okay, that means that it's not going to be compliant with FHA standards. If there's broken windows or holes in the wall, or there's peeling paint, there's all kinds of stuff. I will leave a link below with a link to my website that has highlighted in red most of the things that we see that get hit on an FHA appraisal. But understand that if these things aren't present when they do the FHA appraisal inspection, then they're going to come back subject to completion. And what that means is that the appraisal isn't good. It has to be completed based off of those items that have been found deficient. Now, where that comes and impacts the buyer is once the seller fixes those items, you're going to have to pay about $150 to $175 for the appraisers to go back out there and visually take a look and do a completion report and say, now we're in compliance. So if you know that the house has some deficiencies based upon that list that I provided, before the appraiser gets out there, ensure that those items are addressed, especially like handrails. Get the handrails up before the appraiser gets out there and save yourself $150 to $175 for that reinspection, because you already know the answers to the test. So go ahead, get it addressed, and then we'll do the appraisal. All right, so if there are deficiencies, you need to make sure that your loan officer knows, and then let them know once those deficiencies are corrected so they can order that appraisal immediately. Okay, another piece are gift funds. So can you technically give gift funds for both a down payment and closing costs? Yes, you can. The issue is FHA normally wants you to have a little bit of your own skin in the game, so they want you to have some of your own funds. So oftentimes gift funds will come back a refer with caution in the automatic underwriting system, meaning that it's not allowing you to use full gift funds. So you can't just assume that you can use gift funds. The higher your credit score, especially once you get above a 640, the lower those risk factors are, the layered risk, and the bigger chance you have of being able to use it all. Now, there's no blanket for that. I had a 580 something credit score one time. They received $20,000 in gift funds and I got approved eligible. So you never ever know. You have to run it, and that's key. Is the loan officer must run it through the automatic underwriting system to see if that works. And then, if it doesn't, then maybe they add in some of your own funds. What if you can save up another grand or two? And will that mitigate that risk and get you an approved eligible? The loan officer has to play with those a little bit. Can you use gift funds? Yes. Does it have to be approved? Yes. So just don't assume. All right. Whenever I'm talking to a client and they say they'll come up with the money, big red flags. All right. I have to know where it came from. And I ask, where are you going to get the money? And if they say, well, I'm going to get it from so-and-so, then I've got two things. First of all, a gift fund has to come from a relative. It cannot come from a friend. Okay. As long as it's coming from a relative, I have to be able to run that. So that is important. So if you plan on getting down payment assistance from a relative, let your loan officer know, because that is important. It has to be entered into the application separately as a gift, and the underwriting system must be run as a gift. All right. Now, one of the good things about an FHA loan is the down payment. You don't have to have 20% down. You don't have to have 10% down. FHA allows you to put as little as 3.5% down on a home, and that's huge. So conventional, sometimes you can go down to 3%, but it depends. On average, people then tend to put 5% to 20% down on a conventional loan. Your VA loans and your USDA loans are zero loan products, but those are separate. With an FHA loan, most people end up getting into that because it has one of the lowest down payment features that you can do. So, very positive. When I'm talking to first-time home buyers, a lot of them say, well, can I get this loan with no money down? Well, I'm a first-time home buyer. I hear that all the time. I'm a first-time home buyer. What programs do you have? There's a misconception about the first-time home buyer. All right? Being a first-time home buyer does not automatically mean that you get no money down. Most first-time home buyers will end up in an FHA loan. Now, there are down payment assistance programs and some other things. If you qualify for a USDA loan, watch this video. Then of course we'll go that direction. But if you don't, an FHA loan is a fantastic way to get into a home with very little down. All right, I hope this answered all of your questions. If not, leave them in the comments below. I'm happy to answer anything that you have. But until next time, it's all for one and one for all.